Okay, we are in chapter 9, and we're looking at depreciation. So in our selected problems, we have some problems that we're going to do that are very similar. So we've got 4, 5, 6, 7, 8, and 9, and they use all the same facts. So these are the facts that we're going to use. The cost of this asset is $100,000. Useful life, 5 years. Salvage value, $10,000. And for the first 3 problems, we purchased this asset January 1st, year 1. So when I start 4, 5, and 6, the only difference between these problems is the method that we're going to use. So for method 3, or in problem 3, we're going to use straight line. For number 4, we are going to use double declining. And for number 5, we're going to use units of production. So in depreciation, or in accounting, there are only a few never, ever, ever, ever violate the rules, or things that are always true. So we looked earlier, for every transaction there's at least one debit and at least one credit. Assets always equal liabilities and shareholder equity. Those things are always true. When it comes to depreciation, I don't care which method we're using, the maximum amount of depreciation that I can take is cost minus salvage value. And done right, straight line will never break this rule. But if I ask you on a test about units of activity or double declining, you can be well assured I'm going to make it break this rule. And I need you to know, all right, that we can only depreciate cost minus salvage value. So in this particular example, the maximum amount of depreciation, regardless of the method, that I can take is $90,000. The cost of the asset minus the salvage value. So we're going to look at straight line first. We've seen this in chapter 4. So we know that annual depreciation for straight line equals cost minus salvage value over useful life. And because we purchased this asset on January 1st, we have it for a whole year. I don't have to prorate this. So there's some things I need to know. I want to be able to calculate depreciation. I want to be able to calculate accumulated depreciation. And I need to be able to calculate book value. So when we look at our selected problems, we have got 3 columns for these things. Okay? Hopefully we remember the book value is cost minus accumulated depreciation. The wonderful thing about straight line depreciation, it is the same every year. So when I take this problem, this asset, and I put in cost, $100,000, subtract out salvage value, $10,000, divide by useful life, 5 years. Every year, my depreciation is going to be $18,000. So, when I go to fill in this chart, I've got year 1, year 2, year 3, 4, and 5. And every year is going to be this $18,000. Accumulated depreciation is all the depreciation we've ever had, So in the first year, when I take $18,000 of depreciation, my accumulated depreciation is $18,000. But when I get to next year, in the second year, I'm going to take another $18,000 worth of depreciation. So accumulated depreciation is last year's depreciation plus this year's depreciation, or $36,000. And when I take $18,000 again in the third year, if I take the 18 times the 3, this 36 plus this 18, this will give me 54,000. Carrying through, using our handy dandy calculator, this will be 72,000, and then 90,000. Notice that the maximum amount of depreciation equals the total amount of depreciation in straight line. If we do the math right, we will never violate the rule. So let's look at book value. Book value is cost minus salvage value. So in the first year, my cost is $100,000. Accumulated depreciation in the first year, $18,000. So I have a book value of $82,000 in the first year. When I get to year 2, I want to take the cost of $100,000, but now my accumulated depreciation is $36,000. So if I take $100 and I subtract out the $36,000, my calculator will behave. I'll get $64,000. And when I take 100 and subtract out 54, I will get 46. And when I take 100 minus 72, I will get 28. And when I take 100 and subtract out 90, I will get 10. I don't care which method we use, whether we are using straight line, double declining, or units of production. When you get to the end of the useful life of this asset, if it does not equal salvage value, we've done something wrong. And when I see it, I look, salvage value is $10,000, so I'm feeling quite happy about that. Okay, so straight line is really easy. All right, we take cost minus salvage value divided by useful life. It's the same amount every year. Right? We're allocating this asset to expense evenly. So, 2 rules in depreciation that are never violated, right? The maximum amount of depreciation is $90,000. We can never depreciate more than cost minus salvage value. And secondly, at the end of useful life, book value better equal salvage value. Okay. So, now we're going to go move on to the second example, right? So we're going to use the same facts, double declining. I still want to know depreciation, accumulated depreciation, book value for my asset. This asset was purchased on January 1st. So I do get a whole year's worth of depreciation in our first year. So annual depreciation for double declining. I want to take book value times 2 over useful life. Okay. So now we are going to get a different amount for every year. In fact, this is an accelerated depreciation method. So our costs in the first year will be very high and they will go down over time. Part of the argument is that we get the majority of its use at the beginning of the asset. The other is to even out our costs, because we assume as an asset gets older, the repair and maintenance goes up. So as I have my costs coming down for depreciation, but my maintenance and repair going up, it evens out over the years, because we would assume it would have very little repair and maintenance at the beginning of its life. So let's look at year 1. This asset costs $100,000, and at this moment it has absolutely no accumulated depreciation. So when I look at book value, which is cost minus accumulated depreciation, cost is $100,000. And at this moment, accumulated depreciation is 0. So when I go to calculate depreciation, I want to take the $100,000 book value and multiply by 2 over useful life. And this asset has a useful life of 5 years. So the double in double declining comes from this 2. And when I take 2 over 5, this comes to 40%. So I'm going to take 40% of this asset, book value, for depreciation every year. So 40% of 100,000 will give me depreciation of 40,000 in year 1. My accumulated depreciation at this point now is 40,000. Book value, remember, is cost minus accumulated depreciation. Book value. So 100,000 minus 40,000. Book value is 60,000 at the end of year 1. Be careful. When I go into year 2, I need to make sure that I bring in book value. This formula says book value. And so now book value in year 2 is 60,000. So I'm going to take 60,000 times my 40%. So it'll give me 24,000. So it's a different amount than last year. And when I go to get accumulated depreciation, I had 40 last year, 24 this year. This will give me 64. And book value will become 36. Now we need to be really careful. This is one of those rules that will violate the max almost every time. We cannot exceed $90,000. And so far I've only depreciated this asset 64. But we need to be really careful and watch out for that. So I get to year 3. Book value is now 36,000. I want 40% of that. So if I take 36,000, multiply by 0.4, this will give me 14,400. And when I add that to 64,000, I'm not going to exceed 90. So we're good there. This gives me 78,400. And when I subtract that from $100,000 to get my book value, I'm left with 21,600, which becomes my book value in year 4, or the beginning of year 4, right? And I'm going to take that times 40%. My depreciation, mathematically, 8,640. When I add that to the 78,000, I don't think it's going to exceed 90, so I accept this. And this will give me $87,040. Remember, the maximum's 90,000, so I haven't exceeded yet. Life is good. When I subtract that from 100,000, my book value, 12,960. I'll bring this in. Year 5. I want 40% of this. And when I do that math, I get $5,184. If I add $5,184 to this number, we're going to exceed the 90,000. So I have to reject this amount. I know the maximum is 90,000. I also know I've already depreciated $87,040. And so if I net that amount, then I'll know the maximum that I am allowed to take. And it ends up being $2,960. When I add that to the $87,040, this gives me $90,000. And when I subtract $90,000 from $100,000, this leaves me a book value of $10,000, which is indeed equal to salvage value, a rule that I have to have. So right now, I know we're still depreciating these assets, but let's think about in a little bit. I bought them in an earlier part of this lecture. I'm using them up now, depreciation. And at some point, I'm going to sell these assets. But sometimes I sell it before the end of its useful life of 5 years. And so just for fun, let's talk about selling this particular asset, say at the end of year 2. my books for $36,000. And if I sell it for $40,000, do you think I've had a gain or a loss? And I'm hoping you'll tell me, because I sold it for more than what it's on my books for. It's on my books at 36, and I sold it for 40,000. I'm hoping you would tell me that it was a gain of 4,000. But let's change it up a little. Let's sell it at the end of year one. Do we agree on the end of year one, it's on my books for $60,000? If I can only sell it for $30,000, oh, that's a coincidental number. Let's change that. It's on my books for $60,000, but let's say I sell it for $50,000. Do I have a gain or a loss? I'm hoping you will tell me, right? It's on my books for 60 and I only sell it for 50, but I've had a loss of 10,000. Okay, so last method with these facts before I change the date of purchase. We have one more method, units of production. Let's look at that method. Still true, the most I can depreciate is 90,000, and still also true, at the end of useful life, book value better equal salvage value. So, units of production, also called units of activity, depending on the age of the person you're speaking to, generally, is much like straight line, except it's going to be per usage. Right? There's something that tells us exactly how much something is used. Because if depreciation is a systematic allocation from asset to expense based on usage, right? If I know the exact usage, well, that would help my calculation out a lot. So in this case, we are not going to base units of activity or production on time. We're going to base it on actual usage. So sometimes if we have a company car, well, that might be mileage. If we have a machine, it might be machine hours used. If it's a machine that puts out parts, maybe it's the number of shots that that machine will make. So in our case, it tells us in this part that this asset has a useful life, right? And instead of time, it tells us that our useful life is, let's read this together. 60,000 machine hours. So if the useful life is 60,000 machine hours, machine hours, when I go to get my per activity depreciation, I'm going to take cost minus salvage value over useful life. But now, instead of being time, my useful life is machine hours. So cost is 100,000. Salvage value is still 10,000. Except now I'm spreading that over 60,000 machine hours. And my depreciation is going to be $1.50 a machine hour. So now, every year, when I use the machine, depending on how many hours I use, I will multiply it by the $1.50, and that will give me, my depreciation. And in case of a year I don't use the machine, well, then I'll have no depreciation. So year one, it goes ahead in this particular problem, and it tells us some facts. Right? It tells us that in year one, we use 12,000 machine hours. In year two, we use 25,000 machine hours. In year three, we used 0 machine hours. In year four, I used 20,000 machine hours. And then in year five, I used 5,000 machine hours. So let's go ahead and calculate depreciation, accumulated depreciation, and book value for each of these situations. So in year one, I'm going to take the 12,000 machine hours, multiply it by $1.50 a machine hour. This will give me $18,000. Because this is my first year of depreciation, my accumulated total depreciation is 18,000. And when I subtract this 18,000 from the cost of 100,000, we're going to come up with 82,000. Year 2, I use this machine, 25,000 machine hours, at $1.50 a machine hour. Looks like my depreciation is $37,500. And when I add that to last year's 18,000, I'm going to come up with 55,500. And when I subtract that from 100,000, I'm going to come up with $44,500. Year 3, I didn't use it. 0 times anything is 0. When I add 0 to the 55,500 from earlier, still 55,500, giving me a book value, $44,500. Now be careful. I cannot exceed 90,000. So far I haven't. Life is good. Year 4, I come in 20,000, $1.50. Gives me 30,000. When I take 30,000 and add it in, I'm good. 85,500. This gives me 14,500. And then I come into year 5. You know me. You know on the test and on the quiz, I'm going to make it just like this. You know I'm going to make it exceed. It's your job to catch it. $1.50. This gives me $7,500. You know this $7,500 plus this $85,500 is going to exceed $90,000. So we have to reject this. I take the maximum I'm allowed, $90,000. I subtract out the amount I have already depreciated. And this will give me $4,500 is the amount that I would like to depreciate in year 5. When I add that to my accumulated depreciation, I get 90,000, and when I take my 90,000 from 100,000, I'm left with a book value of 10. That in a nutshell are our first 3 methods, right? Assuming that we purchased this on January 1st. In our next video, we're going to keep the same facts, except now I'm going to purchase it on a different day. So I'm going to have to allocate my depreciation. So, tune back in, and we will take care of that in just a little bit.